Most investors missed the AI boom because they waited for proof. By the time ChatGPT launched, the easy money was gone. But right now, a $20 billion shift is happening in a technology even more powerful than AI: quantum computing. In 2026, we are at the exact same inflection point. The global quantum market is projected to grow from $1.88 billion today to nearly $20 billion by 2035. That is a 30% compounded annual growth rate, and most retail investors haven't even started paying attention yet. But here's what I need you to understand before you rush out and start buying stocks. There is a pattern that plays out with every single major technology revolution, and if you don't understand it before you put money in, it will cost you. The technology always wins, but the investors may still lose. So in this video, I'm going to break down the different risk levels and how you can actually get into this technology, so you understand exactly what you're buying, what could go wrong, and where the real opportunities are. But before we get into any of that, I want to show you something that happened 25 years ago, because it is the most important thing you'll hear in this entire video. Cisco built the backbone of the modern internet. The technology won, the business won, and its stock still hasn't recovered its year 2000 peak more than 25 years later. That's the gap we are navigating today. Identifying a winning technology and making a winning investment are two completely different things. So before we talk about where to put your money, let's make sure you actually understand what quantum computing is and why the opportunity is as big as what people are saying. Classical computers, the one in your phone, your laptop, every server running the internet right now, they process information using bits, zeros, and ones. Every video you watch, every message you send, every transaction you make is just a massive sequence of those zeros and ones. Quantum computers are fundamentally different. Think of a normal computer like a librarian who has to check every shelf one by one to find your book. A quantum computer is like having thousands of librarians who check every shelf at the exact same time. It doesn't just do things faster, it changes what's actually possible. That's what qubits do. Because of two principles of quantum mechanics, superposition and entanglement, a qubit doesn't have to be just a 0 or 1. It can be both at the same time, and that completely changes the scale of problems you can solve. Drug discovery, financial risk modeling, supply chain optimization, advanced cryptography. Problems so complex that even the world's most powerful supercomputers today would take billions of years to crack them. A quantum computer could solve these in minutes. Now, I know that sounds like science fiction, but here's the part that should actually keep you awake at night. The investors who win aren't the ones who understand the physics. They're the ones who understand the market cycle. And right now, the market cycle on quantum computing looks very familiar, which brings me to something that completely changed how I think about investing in spaces like this. Think back 5 years ago. The semiconductor boom was just getting started. Nobody knew which company was going to win: Nvidia, AMD, Micron. Here's what happened if you just bought SMH, the semiconductor ETF, 5 years ago. You'll be up over 350% today. You didn't have to pick the winner. You just owned all of them. We are at the same moment with quantum right now. Nobody can tell you with confidence which company wins the race. And that uncertainty is exactly why how you invest matters as much as whether you invest. So let's break it down by risk level, starting with the safest entry point. Large technology companies that are already profitable, already doing some serious quantum research, and don't need quantum to justify their valuation today. Alphabet, Microsoft, IBM, and Honeywell are the key names here. Alphabet's Willow chip is making genuine technical progress. IBM has over 250 organizations already accessing quantum systems through the cloud. Honeywell owns the majority of QNTM, which just raised $600 million at $10 billion valuation. The idea is simple. If quantum succeeds ahead of schedule, you participate in its upside. If it takes longer than expected, you are still holding a highly profitable business. The upside is real. It's just more measured than what we're about to get into. Because if you want to know about the company that just reported 755% year-on-year revenue growth, the high-stakes pure plays that could make or break a portfolio, we are diving into those in just a few minutes. But first, the middle ground. And for a lot of investors, this is actually where the smartest money is going. Quantum-focused ETFs. You don't know which pure play quantum company is going to win. Neither do I. Neither does anyone. So instead of betting on one name, you buy a basket of them through an ETF, a single fund that holds multiple companies across the quantum space, and let the space do the work. Think of it exactly like this semiconductor ETF example. You're not picking the winner. You are owning the whole race. There are a few worth knowing about. The first is QTUM, the Defiance Quantum ETF. This is the most established quantum ETF out there. It's been here around about 8 years and holds 86 companies and has averaged around 25% annually since inception. The catch is it's not purely quantum. A lot of its top holdings overlap with the broader tech funds you might already know. The second is WQTM, Wisdom Tree Quantum Computing Fund. This one is newer but more concentrated. Its top 10 holdings account for over 40% of the fund's total weight, and it's heavily weighted towards pure play quantum names. It also has very little overlap with broader tech funds, which is actually a benefit if you already hold something like QQM. The con is it's been around less than a year, so there is limited performance history to go on. There are also two UCITS ETF worth knowing about for non-US investors: QANT from iShares and QNTM from VanEck. Both have very high concentrations of actual quantum computing companies and are worth a closer look if your broker supports them. For most investors who don't want to spend hours researching individual companies, an ETF is genuinely the smarter move. You trade some potential upside for meaningful downside protection. An ETF forces the diversification that protects you from your own conviction bias. Now, if you have been patient, here's the part that gets really interesting. The pure play quantum stocks, the highest risk level and the one with the most potential to either change your portfolio or seriously damage it. These are the companies whose entire business is quantum computing. No profitable side business to fall back on, no established revenue base to cushion a bad quarter. Their valuation is almost entirely built on the expectation of a future that hasn't fully arrived yet. There are three risks you need to understand going in. Timeline risk. This technology could take longer to commercialize than the market currently prices in. Dilution risk. Most of these companies are still burning cash and regularly issuing new shares, which shrinks your stake over time. And survival risk. Not every company in a winning technology actually survives long enough to benefit. Some run out of money, some get outcompeted. Well, that is the reality of early stage investing. With that said, there are genuinely some interesting things happening in this space right now. IonQ is a name that keeps coming up in research, and for good reason. They just posted a 64.7 million in revenue, a 755% year-over-year increase, and have guided up to around 270 million in 2026 revenue. They are out-earning almost all other pure play competitors combined. But what makes IonQ particularly interesting isn't just the revenue growth, it's the strategy behind it. Instead of just trying to build the best quantum computer, they are building the entire quantum stack. They have been acquiring companies across quantum cybersecurity, photonic interconnects, precision sensing, and satellite communications. They recently announced plans to bring chip manufacturing in-house through a Skywater technology acquisition, which gives them even more control over their supply chain and stronger positioning for US government contracts. The moat they are building isn't just hardware, it's an ecosystem. Whether that pays off is still an open question. But as pure play quantum companies go, IonQ is the one that's starting to look less like a research project and more like an actual business. Which brings me to you. Drop in the comments which pure play quantum stocks you are watching or already holding. I'm working on a dedicated deep dive into the most promising individual names, and I want to know what is on your radar before I put that together. There are companies in this space that are more commercially mature than others, and I want to cover the ones you actually care about. Just remember, this is early stage technology. The risk is real, so you should keep your eyes open. Let's bring this together. Think of it as a pyramid, large tech at the base, Alphabet, IBM, Microsoft, Honeywell, ETFs in the middle, QTUM, WQTM, and QNTM, and pure play stocks at the top, the smallest, highest risk slice. Build it in that order. Strong foundation first, speculation on top. You still have time to get positioned in the quantum before this becomes obvious to everyone. But obvious is when the easy money is already gone. If you are ready to start, I have linked my Longbridge referral link in the description. It's the platform that I personally use to access these stocks and ETFs, and they have some welcome bonuses available for new signups for Singapore-based users. Link is down below. Drop your quantum picks in the comments. I read everyone. My name is Rama, and I will see you in the next video.